All right, everybody, so we're going to go ahead and get started. For those of you who have not had the pleasure of connecting with yet, my name is Wenner. I'm the CEO and founder here at DLP, and we're going to start this webinar here. It's going to be a start of a weekly session we're going to do each week so we can keep in communication with our existing investors as well as future investors, as well as we have team members and other types of clients here with us as well. And what I'm going to focus on doing is kind of sharing what's going on here at DLP in light of this, somewhat new world we're all living in. Talk a little bit about how what's happening today is affecting our world, affecting the world of real estate, the economy. Share with you some of the insights we garner from all the business lines that we run and all the kind of direct communication we have, and give an opportunity to ask questions. So I'm going to today on our first one keep it somewhat short, I think, in terms of the real content and updates I want to share to kick us off. And then I'm going to leave lots of time to answer your questions. I'll probably address a lot of the questions throughout, but if I don't, we're going to open it up to questions here in the Zoom meeting. Or if you're in, you can start typing questions in the chat box. If you're on social media, of course, you know how to type in comments or questions there as well. And then at the end, we'll open it up here and tackle any and all questions. So hopefully that works for all of you guys here. So I want to start off here with, before I get into the meat of that we're all in and how it's affecting real estate, I want to first start off with some good news, which is probably something a lot of us haven't heard a whole lot of here recently. Really not even good news, it's great news. Here at DLP, we are strong. We were ready for this, not exactly this, right? Because nobody knew this exactly how the next recession was going to come, but we were ready for turbulence, for volatility, and we built the business knowing that would come. As we built this business through the last recession, we have 360 team members strong, all working, all ready, all excited and energized and pumped and productive right now, despite working from home, despite some of the challenges that come from that, despite everything we hear around us, because we know what we do here at DLP is very much needed today and right now in this environment, and we're positioned because we've been getting ready for quite some time to be able to capitalize on this type of opportunity in terms of an economic standpoint, in terms of being able to be strong and grow and continue to employ our team members and grow our organization and generate great returns to our investors, continue to avoid losses. I know that's a term you've been hearing and seeing quite a bit of late if you're anywhere invested in the markets. We are more confident now than ever that we will avoid all losses. We will continue to generate monthly distributions to our investors and generate certainly much above market level returns. And before I kind of kick in to the kind of topic of the kind of effects and what's happened the last couple of weeks, I'm going to share something here. And on the screen, you see, I'm not going to really use a lot of slides or anything here today, and we're going to have a conversation, but I want to show you something from January, which seems like forever ago and what's been happening, but something that we went through and what we call our Vision Day that we do each year in January. We outline our direction of where we're going as an organization. So I pulled a couple of the slides from that, and I want to show you one here. This here is what we call our elite statement. This is a statement that we say as an organization what we're going to accomplish, kind of a rallying to what we're going to do right here, right now. And this is part of our compass of laying out the direction of the organization. This was from 6-7 weeks ago. We do this every year. And if you're interested in learning more about and seeing kind of our full Vision Day and our whole strategy and our compass and our direction, we'd be happy to send that to you. But this is one slide and one important piece of our Vision Day, which is we call our elite statement. And I'm just going to go through and read off some of this here for you and highlight a couple of important items that I think are pretty cool to look at here where we sit today. So I'll start at the top. We provide elite real estate investment funds by investing in and with the best operators. We live our purpose, carried out by our mission, centered by our core values, and guided by our compass. We will achieve the goals we set on our compass through world-class utilization of our elite execution system. We will operate and grow lean with a founder's mentality. We will drive results through ownership, accountability, and leadership. We'll remain obsessed on the front line. We will prosper through our team members living fully, having happy, productive leaders. We will invest in the Lord, we invest in people, we invest in residential housing in that order. And then the one here that I wanted to really hit on, I skipped over there by mistake. We will be prepared to avoid losses, mitigate risks, protect jobs, and capitalize on volatility. So this was a presentation on January 17th to our entire organization. This was by far not the first time the team has heard us say those things. We will be prepared to avoid losses, mitigate risk, protect jobs, and capitalize on volatility. And here we are 7-8 weeks later, and the greatest volatility we've seen in at least a decade, and arguably in most of our lifetime, in some pretty unprecedented conditions. But we've been preparing, not knowing when, but knowing this would come here in short order, and focusing on generating and driving and growing a productive organization with cash flow, prepared to tackle this. So with that said, talk a little about, the new world, the issues we face today. We are obviously in a pandemic. We have businesses closed. Unemployment is going to increase. I mean, that's essentially a fact at this point. Hospitality and retail industries are being crushed. People are obviously working from home. Kids are out of school. Essential items that you're used to being able to pick up so easily are now a bit more challenging to get. Obviously, big item for most of you as investors, stock market crashed. And I think an important point to mention is I don't think it's done crashing. There's probably quite a bit to go, especially in a lot of sectors. Treasury interest rates, lowest ever. We're at treasury rates near zero. The oil industry has crashed. Banks and lenders are stopping lending all over the place. They're just not lending at all. Really unique change that's really never happened before. We're dealing with situations today where residents or tenants in properties basically can't be evicted because government's putting a moratorium against it, and then some municipalities, the offices are literally closed that you just can't evict. We will see property value decline, especially in commercial real estate, but we will see property value declines. And in my eyes, I hate to say this here because it's not a word anybody likes to hear, but we are heading into a recession. But recessions happen, they're needed, they reset, they kind of clear the decks, and the best companies, do well. And you're able, once you get into recession, that means you're on the path to recovery. You're either path towards recession or path of recovering and growing. You're in one or the other. And we're right now on a path of recession, but there's a lot of really positive things about the fundamentals of today's economy, but there's going to be some challenges here in this new environment. None of us know how long this is going to go on, how much deeper it's going to get in terms of the virus itself. But there's going to be some significant, market shifts and some challenges that we face. I want to definitely make a comment, here, make sure to acknowledge, our heart goes out to a lot of the investors here, the people who've been invested heavily in the markets and have been hurt quite a bit and have had nest eggs and retirement accounts and so forth, suffer some significant losses. And we also, even more so, of course, want to mention, the virus itself and the health concerns and issues that, many people around the world are dealing with is the center of a lot of what's happening here today. And hopefully none of you have been affected directly or your families, and pray that remains that way. So with that said, kind of the silver lining per se here at DLP, the way we think about this situation is, again, we've been prepared for this, that these uncertain times we're in today are temporary. This won't last forever. It's temporary. We don't know if that means a month, 3 months, a year. And we've built our organization on what you see on the screen right here, which is what we call the 20-mile march, which, again, these are slides that we do. Basically, I present on the 20-mile march every month. I present this to every new team member who joins DLP. We present this constantly because this has been our guiding focus and our guiding message for over a decade here now. And what's driven our success is this focus on this 20-mile march. And some of you who are existing investors have heard me talk on this before, so I apologize for any repeat here. But I think it's worth highlighting here and reminding us in terms. And if some of you run your own businesses and so forth, the concept of the 20-mile march. And I'm going to skip here forward a couple of slides. Then I guess I don't have them all in here, but 20-mile march is the concept that, in all the things that go on in the world, there's very little at the end of the day that you or I can control. We can't control, and this is literally what we say, and I say this every month, we can't control the economy, we can't control global competition, we can't control weather, we can't control most of what goes on around us, but we can control our activities. We can control what we do each day. And here at DLP, we focus on making sure each and every team member focuses on staying in control of their activities, of consistent, disciplined activity. And that's what the 20-mile march is all about. And the term, the 20-mile march, comes from 2 expedition crews that set out to go to the South Pole. And no one had ever been to the South Pole before. And you can read what's on the slides here, but I'm going to paraphrase here. This was, again, before GPS, before cell phones, et cetera, 1911, that the 2 expedition groups set out to the South Pole. And, one group would, every single day when they were marching, they would march 20 miles. No matter if it was, really great weather, warm weather, clear skies, wind at their back, they would march 20 miles. They wouldn't go any faster or any further. But then on really cold days where they didn't want to go anywhere, they wanted to stay in their tents all day, they would continue on and force themselves to get up and march 20 miles. While that's the group who got there first. The other expedition crew, led by Robert Falcon Scott, they would let the outside world dictate their activities. So on good days, they would go 30, 40 miles in a day. And on bad days, they'd stay in their tent and go nowhere. And the group who let the outside world dictate what they did not only got to the South Pole 31 days later, but they actually all perished on their way back. And that parable, this story, is really kind of summarizes the concept of the decision to focus on controlling what we control and not getting too caught up in what's going on around us and things outside of our control. Certainly need to pay attention to it, but taking control of our world and what we're able to control. And there's never been a time that's been more resonates more, at least to me, than the time we're in right now. And you see some of the kind of the summary to that here in terms of how that affects us. And we talk and teach, and this is one of our core values here at DLP. And this is one of the reasons we've been able to grow by over 60% every year for 14 years now, while growing more profitable, while never losing money, while exceeding our investor returns, while generating monthly returns, double-digit returns for investors month in and month out, and why we're really confident in where we sit today. And and the center of all that is this: it's great people. This is just a few weeks ago here in Florida at a company party. Here's at our Pennsylvania office. Here's some people on our Vision Day, the day I was mentioning earlier, out at our St. Augustine in Florida and Orlando offices. And as you see here on this slide, at DLP, we control all the components of executing on our investment properties. And we run the same 20-mile march, focused, disciplined approach, disciplined thought, disciplined people, disciplined action throughout all of our businesses. And so we're doing the construction, we're doing the property management, we have real estate brokers helping people sell their homes quickly, taking the risk out of the sale of their home, helping home buyers. We have our direct lending business providing direct loans to real estate investors, Bright Homes doing new construction, title company, loan servicing. Literally, we're handling all the components of executing on our investment approach in-house, under our control, our employees, our people, all running the same system with the same level of focus and discipline. And we feel really confident here, and I guess maybe to get right to where we're at today in terms of DLP, we are right now continuing to make acquisitions. We are continuing to make loans. On new acquisitions, we're taking a lot of we're being very cautious. We're delaying out due diligence periods. We're not closing anything here in the next number of weeks. Any deals we do close will be frankly at reduced prices than what we would have paid for an asset a few weeks ago, because we think there's going to be some level of correction to valuations. So we're very cautious to deals that we do and analyzing deals and being very, very conservative in our expectations. On our direct lending side, we're funding loans. We fund loans every day over the last couple of weeks. We think this is a great opportunity because a lot of lenders simply can't, because their money's tied to Wall Street, tied to the stock market, and are not able to fund loans. So we feel really, really great about being able to fund loans, be able to step in. We're in general reducing even further. We already felt we're incredibly tight guidelines, low risk type lending. We're going to get even tighter on the lending we do, because we're going to have even more opportunities as there's all of a sudden a lot less competition for good borrowers, good lenders. One of the great things about a market like today are the people out there making deals, buying properties, capitalizing on this distress that's in front of us, is that it's the better borrowers, the stronger borrowers, the borrowers who have more cash that are able to do so, they're actively buying, that we're going to be lending to. And we have control over the execution across everything we do. So we're making loans at lower basis to better borrowers at lower leverage points. We're buying properties that produce great cash flow at lower prices. So all in all, those factors result in better returns over the course of time. On the short term, yes, we'll deal with the short term challenges of not being able to evict a tenant who's not paying their rent. That's a challenge that's going to affect everybody in the world of housing. But the investors who don't have cash, who don't have well-managed properties that are largely occupied with good tenants who are screened well, are going to be hit a lot harder, which is going to create a lot of distress for us to be able to capitalize on. But for us, it's not going to put us out of business anyway. It's not going to stop us from being able to still hit our preferred returns to our investors, generate cash flow. But there will be challenges on the short-term basis, that we will have to fight through, that we will have to deal with. And hold on one second there. I had my screen drop out on me here, so I'm just pulling it back up. If you guys, I lost it there for a second. So with that said, and you still hear me there, Kyle, Rich? Give me a thumbs up. You still hear me? All right, cool.
Yep.
Great. So with that said, we're more confident here than really at any time. We're in a great place. We're confident, excited that we really get to show to you, our investors. Many of you on this, I'm looking at the list on here, have been with us for quite a number of years. You get to see us how valuable being an investment approach that is not going to lose money. It's going to generate monthly returns. Still going to generate very solid, strong double-digit returns. How valuable that is, especially in a market like we're in here today. So we're excited to be able to show our investors that, to be able to prove out this investment approach again in this challenging market, and to be able to do so with your confidence and your support, and be able to provide a safe place that you can count on, that you can know you can rebuild some of those losses that you've had here over the last number of weeks, and that we're going to be stronger, we're going to have less competition, and we're going to be capitalizing on buying deals at even better basis here over the weeks and months ahead. So with all that said, and it was a good amount of information here somewhat quickly, but what I want to do now is open it up here. I'm going to pull up my screen again here, but I want to open up the chat box here. I know we already have lots of questions in there to start tackling questions that you guys all have. So again, reminder, you can go ahead and type any questions in the chat box here in Zoom, or if you're in Facebook, within the Facebook chat function as well. And with that said, Kyle, go ahead and let's start tackling questions.
Awesome. Thank you, Don. So we have a question here from Dan. It says, many folks living in affordable housing are impacted the most by unemployment due to coronavirus. Does DLP expect challenges collecting rents in the short term?
Yeah, it's a great question, and short answer is yes, absolutely. There's going to be some challenges, as you said, with short-term rent collection. But that might mean that we have 2 or 3 or 4 or 5 or 6 or 7% of a community that's not able to pay rent here on the short term, and unlike in a normal environment, that we're not going to be able to evict them in short order. And we're certainly going to be working with residents. We've already been doing a lot of work of finding both local and government aid programs that we can start helping connect residents to who get affected, who lose their jobs, who face unemployment or reduction in hours, and are in legitimate challenges here with being able to pay rent. So yes, that will provide some short-term challenges, but that's one of the reasons we've been so focused on investing in larger apartment communities that have a lot of diversity, of building funds that have great volume of diversity, so that overall, as a fund with such a great portfolio of cash flowing assets, we're still going to be able to produce cash flow, albeit there'll be some short-term challenges with some residents just with what's going on until this moratorium on eviction and so forth, and some of the relief plans that are being talked about come to fruition.
All right, excellent. So we have a question here from Alex. It says, for investors who choose to take a cash distribution from pref fund, not converting it to the housing fund, how soon will funds be released, and will final EDC be paid?
Yes, it's a good question. That's a question for those who are in the preferred return equity fund, different than this topic here at hand, but I can get back to you on exact timeline here later today. I don't know if, I'm sure Kyle has, and I know Larry and Rich on who asked that question. I didn't catch it, but we can give you an exact timeline on that. I believe it's in the next 30 to 60 days, I believe is the answer there, but I don't have that exact answer in front of me, so I can get back to you later this afternoon with that exact answer.
Awesome. So we have a question.
And that question only applies to all of, I think, 3 people who didn't, to that question, convert their interest into the housing fund.
We have a follow-up. We have one here from Ken. It says, if you are looking at a fix and flip to lend on, what discount or reduction in value in general would you apply to a property? Is it time to look for value now, or will there be an extended time lag to find better values?
That's a great question. I mean, cash is going to be very, very valuable. Cash is going to be power here to capitalize on the distressed opportunities that will be in front of us. And I want to highlight, well, I know I've used the word capitalize here on distress a couple of times, but it's capitalized in terms of we're going to be able to, and our investors and borrowers are going to be able to buy properties at lower prices because of the state of where things are at. But the way we look at it, and the way we've bought properties from, for the last 12, 13, 14 plus years, has been we're providing a significant need to somebody who needs cash now. So that's often what happens in a situation like this, is those who aren't prepared desperately need cash. And when there's very few who are ready and able to deploy that cash, we're providing a major value that can protect people from loss, can help them solve other even more significant issues by providing them with liquidity and cash. So where we like to be is always in a win-win situation where we're providing somebody who really needs to sell their house because they need money now to avoid losing another property or some major other issue. Us being able to provide them that cash relief very quickly is a major value to them and can create a great value for us and our investors. So with that said, if I was buying a house, and we still are buying houses right now actively, despite the iBuyers of Open Door and OfferPad and these groups have stopped buying, we're actively still buying. But yes, if you're going to buy a house today, you'd want to make sure you're more conservative in your valuation than you were a couple weeks ago in short. So I'd be a little bit more conservative in short to what I expect the value to be at completion, just because there's so many question marks to how value is going to get affected, how quickly. So it might be in short where you're reducing your purchase price 4, 5, 6% right now. Would be, depending on the market you're in, probably a rough number to how we'll ultimately shake out to how we evaluate our prices and what we pay for a house compared to what we would have paid before these last few weeks.
All right, we have one here from Randall. It says, what is a conservative estimate of monthly returns for lending fund during the next several months? I'm assuming some borrowers will be unable to make payments for a period of time.
Yeah, it's a great question, and one I'll be probably prepared to give more clear, harder answers on within the week by the time we meet again a week from now. We're in the process right now of evaluating how much leverage we're going to use in the lending fund. Right now we've always been low leverage. We're debating, if we're going to even lower that leverage further. We're also kind of right now evaluating the market and the opportunities that are coming in and determining if we're going to take this as an opportunity to push up our yields in terms of the interest rates we charge to a borrower. But we're really less focused today. I know it's not necessarily the greatest answer if you were focused on yield, but I think something that hopefully resonates with everybody here. We're much more focused on making sure we're making loans and making decisions that are going to reduce risk than we are focused on maximizing yield right now, where we are in the flux of things here today. But with all that said, I don't expect any dramatic change here. We're still going to continue to generate very solid monthly returns here in lending fund, income and growth fund, fixed fund, all of our lending strategies. But the exact kind of target that I'm going to project out, say, for the next number of months, we're still evaluating here, and I'll be able to dive into that in a little bit more exact specifics next week. But right now, we're originating loans at the same rates and terms in general as we have for the last number of months. On average, I'd say the average borrower we're funding today, because the ones who are most active over the last few weeks are the higher quality borrowers, but our rates certainly have not been going down in terms of what we're charging today on the loans we make. And to your point, yes, there'll be some additional projects will take a little longer to sell in general. There will be a little bit increase in delinquency, but those things don't necessarily hurt our yields. In some cases, they actually help the yields because of the default interest we earn on loans when they do fall behind. So it'll be very active management on our end, which we are having many meetings every day on all these different components, from how we're going to handle and adjust our rent collection processes here today on collecting rent, especially between now and the end of April over this moratorium, and how we're going to work with the residents in collecting what we're able to, considering we can't move forward and evict, and all the uncertainty and wanting to also show compassion for people in tough situations. And those questions we're still working through, but we're very confident that we have great people who are aggressively and actively working through developing the best process to, again, continue to mitigate risk, to bring in the highest amount of collections possible, both on our lending and rental side, and continue to produce great, consistent returns to our investors.
All right, we have one here from Stuart. It says, will you reduce LTV percentage for new loans to provide additional buffer?
Yeah, it's a great question. I'd say in general, my expectation and my short answer to that is probably, but it's going to be a little interesting. So if we can lend to, the very top tier borrowers, guys who have large portfolios of thousands of homes and lots of cash and lots of experience and large operations, I'd rather lend to that guy at the same type of LTVs we're lending at today than even lowering the LTVs 5 or 10% to lend to a guy doing 3 or 4 flips a year. So I think in short, literally right before this meeting, Nate, our president of lending, and myself, we're having a credit discussion of talking about different ways of increasing reserves and different things that we're going to start doing to mitigate risk. So I'd say in short, yes, we're going to be focusing heavily on mitigating risk and being even more cautious and focused on how we do so. Will that translate directly into lower LTVs in every case? No. Across the board, will it most likely? Probably. But we're really focused on the overall risk profile on every loan we do.
All right, we have one here from Anthony. It says, hey, Don, why would I be better off investing with you versus multifamily housing REIT? What competitive advantage do you have that I can't get from that investment avenue?
Well, first I'll say, the DLP Housing Fund, our new fund that we just launched, is a multifamily housing REIT. In short, so it's a REIT that does both multifamily housing and our direct lending strategy, in one fund, and that fund is targeted to distribute 0.5% dividend every month, and it will distribute at least 0.5% dividend every month, with overall returns of over 12% annually, and a lot of reasons why that fund is well positioned, more so than I believe any other multifamily REIT, private or public, that's out there, which we could certainly talk about. But I'm going to assume the question, you can correct me wrong if I'm wrong, I think your question means why would you invest with our fund versus a publicly traded multifamily REIT? That's a big difference. Publicly traded are REITs that you could buy on the stock market versus public or private REITs such as ours. You can only invest directly through us. And I think that one of the big fundamental differences here between a private REIT and a public REIT that we're seeing right now is a lot of public REITs just saw their values drop 20, 30, 40, 50% in a matter of a week or two, because the value is based on perception and fear, not based on the actual value of the real estate. Our value is based on the value of the real estate. So you're investing with us, you're investing based upon the value of the real estate and our ability to generate great cash flow. And then my last comment, I mean, fundamentally, we're buying properties at a better basis. We're much more nimble. We're much more able to capitalize on opportunities and move quickly than the large publicly traded REITs.
One here from Doug. It says, if values are dropping moving forward during this recession and presumably less buyers available at the end, either to the borrower to sell or to us to sell in the market if they default, how do you know you'll have enough collateral to exit without a loss? Are you significantly dropping LTVs?
Yeah, so I think the question was mainly about our loans we make. So today our average loan is around 55% loan to value. So I want to make sure to highlight here, in no way, shape, or form when I mentioned that we're heading into a recessionary environment, am I expecting home values to drop by 50%. We still have a very strong fundamental of a lot greater demand than supply. Of course, that demand may wane in certain cases. So far, example in DLP Realty, we're getting multiple offers right here this week on most properties we put on the market. The single-family home market, largely interest rates are phenomenal, as we all know, has been very, very active. We're selling properties for over asking price right here in this week in the midst of people being locked down in their homes and so forth. So I'm not in any way suggesting that we're going to see that kind of decline in home values. So I want to first start there. So I do not expect us to be upside down on our positions on any of our loans if we got to the point of taking them back. Second, to that point, if we did take a loan back, we're not in the position where we have to sell that house today. The vast majority of the loans we make are properties that could be rented out for a very solid positive cash flow, especially at the basis that we'd be taking those properties back at. And as most of you know, we own over 10,000 apartments and rental homes. We're well positioned and able. We had to take loans back, and if it wasn't a good time to sell them, to rent them out and generate great cash flow. And that's really, I think, to the broader topic as well on our properties we own. We're not going, if property values do, like multifamily, commercial type property values, the demand to buy those properties wanes here significantly, valuation soften, we won't be sellers of properties right now. That's one of the big reasons why we've launched this housing fund. It's an evergreen fund. So we're never in a position where we're forcing the sale of properties when values are low. And when you're buying properties that generate strong double-digit cash flows, you're not in the position that you're being forced to sell because you're generating great cash flow. So we still have many deals under contract right now to sell on the multifamily side. Many cases where borrowers are hard on those purchases and are giving us every indication that they expect to move forward and purchase. So we're still seeing offers coming in on our multifamily properties right now, in many cases over our target prices. So, the market has not completely fallen apart. The demand, in many cases, for people wanting to invest in income-producing workforce housing, I think many are going to see, even with this rent moratorium or eviction moratorium, people are going to, in general, move towards the spaces we're in terms of wanting to own this type of property. I think there'll be a lot less lenders competing with us to lend against it, but there'll be a lot more investors wanting to buy and invest, and especially sophisticated groups wanting to own income-producing real estate for these exact reasons of being in an environment like we're in today.
This one comes in from Hans. It says, for the DLP lending fund, what are the new parameters, LTV, borrower requirements, et cetera, DLP is lending under? How are you dealing with the fact that valuations are basically unknown right now because we have no idea what's going to happen with the virus and the shutdown?
Yeah, so I mean, the question probably came in before I just gave the last answer, so I won't repeat everything again. But I'll highlight, right now today, our average loan to cost is in the low to mid 70s, and our average loan to value is in the mid 50s. Could we decrease those even further over the months to come? That very likely could happen. We're also focused on increasing, liquidity requirements for our borrowers, and in a lot of cases increasing, installing that they have to put in up interest reserves as well. So we're doing things to make sure the borrowers have liquidity to handle a project if it takes longer to sell, if they have cost overruns. And then, by being in the kind of LTV we're at, again, I'm not expecting a big percentage of these, property values to decline anywhere by a significant percentage. If we saw, over the rest of this year in single-family homes, a 5 to a 10%, market-wide decline in value, that would be, I think that would be on the very extreme end of what I expect to see. But that's on the overall market. So I think sometimes where people get caught up is, when we're buying properties, when I say there's going to be distress, we buy deals, not markets. And so there will be people in distress who need to sell properties quickly and need to get cash out quickly. That doesn't mean the entire market is going to be in distress and all property values are going to drop. But there'll be, small percentages of any market of deals that where there's a higher level of motivation for the ability to execute quicker than going to the market and selling in traditional manner. So there will be distressed opportunities to capitalize and to buy, but I'm not anticipating the whole market's going to go into distress and property values are going to drop 20, 30, 40% tomorrow. There's still phenomenal fundamentals in supply and demand of housing in America today.
And this is a direct follow-up to that. It says, do you have or are you working on a reserve amount for the lending fund to cover possible losses on borrower defaults if housing valuations crater?
So, for those of you who've been investors for all, you probably already know this. For those of you who want to get, I'll kind of communicate this here. So our business practice over the past 6 years is when we get a loan that goes into default to the point that we expect we're going to end up having to take that real estate over. We're going to have to own the real estate. Our business practice has always been and is going to remain that DLP purchases that loan for 100% of the outstanding principal and past due interest from the fund. So we are still providing that backstop on our loans. I have no anticipation of changing that business practice. So with that said, if there was heavy increase in opportunities to buy distressed debt, as an example, out in the market, we could focus on having that as part of a business strategy here at DLP. But today, when we originate loans that go into defaults, we take over that property if it gets to the point of having to take over ownership. The vast majority of properties that go delinquent or into default, get paid off. The borrower sells it, refinances it, et cetera. But if it gets to the point where we take ownership, we do that. The fund doesn't take that risk or liability. In addition, the lending fund does have a large interest reserve account to cover if we had any losses on an individual loan, that we could utilize that reserve account to cover any losses. We've never touched our reserve account. We don't intend to change that. We don't intend to tap into that reserve account or expect to in any way, but we do have that set up right now, and I've always have, and it continues to grow as the fund continues to grow. And that's the other important thing I think I don't know if I've highlighted here today. Our expectation here at DLP is not only are we going to be managing the investments we have, not only are we going to continue to deploy the capital we have into new loans and into new acquisitions, we are 100% open for business for new investments, and we are absolutely expecting Q2, which, believe it or not, going to be here in a few days, will be our largest quarter ever in new capital raised as we continue to invest and continue to be able to provide solutions in this changing environment. So we're very confident that we're going to be able to continue to originate loans at very low risk, at great yields, and then we're able to buy properties at really phenomenal basis that are going to produce great cash flow. So I want to make sure, if I haven't made that clear, that that's absolutely our expectation here over the months to come.
All right, we have one here from Matt. It says, have you done any analysis of the percentage exposure of service industry tenants that are in the portfolio that are likely going to be affected?
Yeah, that's a great question. And yeah, we're actively doing that right now. I mean, the deals we have under contract, that's a big, heavy area. We always dive into the resident profile, their employment, et cetera, in our acquisition process, but we're diving into that even deeper on the properties we're evaluating acquiring today. And yes, at our properties, at our sites right now, all of our property management leadership, all the actual general managers at the properties, the area and regional managers, directors of operations, VPs, are all going through all of our communities right now and putting that type of analysis together in terms of the expected risk profile that we're going to face at that community. And actually, tomorrow morning we have a call laying out the approach we're going to take for finalizing the approach we're taking. It's going to vary in some communities for some of those factors. Here for March rent, any that's due. Thus far, we're doing pretty darn great here in March, actually, and then preparing for April delinquency. So absolutely, it's a great question.
All right, this one comes from Lee, one of the employees here at DLP. It says, how can we as employees help DLP outside of our job descriptions to help in any way?
So the question was, is that from Lee, who said, how can team members at DLP help? Is that what he said?
Yep, he's basically asking, how can team members help outside of our normal job descriptions to help DLP?
Awesome. And before I answer that question, Lee, I'm going to highlight Anthony, just jot a note here. Anthony Rubin, who's our head of investments, just mentioned the last property we just bought, which was Village at Wexford, about 3 weeks ago. Our resident base there is 35% government, 35% senior retayees, 30% doctors and people in the medical field, with a mix of his doctors, attorneys, and police is a big percentage of that base. So a lot of our properties are not heavily exposed to the hospitality space, as per that last question. So that's a comment worth mentioning there from Anthony. That is something we analyze on every property we buy and look for that diversity and look for people with employment that's likely to weather recessionary environments. So in terms of Lee's question there and how DLP team members can help, so DLP is kind of works out really well here as well, in that Kyle, if you can go ahead and move to the core value slide there real quick. Just in January here of this year, we added a 10th core value here at DLP, which is, I think it's a couple more slides to come, which is stewardship. And pretty timely that we added this as a focused core value, and it's been really a center of our discussion in the organization over the last couple months here. It's always been a focus of the company, but had not been an official core value. And so I would just start there and say, understanding that every person in the organization's job is to be stewards here to our investors in this meeting, stewards to our residents at our properties, to our entire client base, stewards to the resources that we have, in our control here, from the capital we manage, the properties we manage, the loans we manage, the people who work here at DLP, stewards to all of our resources is really more so than ever everybody's job here at DLP. It's every one of our jobs. We focused on avoiding risk. We focused on driving productivity. To be focused on understanding. Lee is in sales, understanding that our job in sales is continuing to originate great business, so that we can continue to take in new capital, protect that capital, continue to grow and protect the jobs of our team members here at DLP, and whether this upcoming environment, for however long it
Awesome, thanks. And we have a question here from Jennifer. It says, with the current situation, are you changing or increasing your due diligence you conduct on properties you may want to buy?
Yeah, absolutely. So we highlighted, a moment ago, the increased due diligence on the resident profiles to the next, to even deeper level, but we're also, paying close attention to that overall market and how it's going to be affected. We're making sure we, really understand how the capital markets are going to be affected in that area. So, example, certain markets, that are more exposed to oil and gas are going to be affected harder, right now, as an example. So absolutely, we've already been moving in the direction I feel we've done a great job on due diligence for many years now. But we've already, way before this, been spending a tremendous amount of time here internally building out our on-site due diligence teams even further, building out, the depth of what we do, building out some even more third-party experts, such as a building envelope company that specializes in coming in and doing a full evaluation of building envelope to evaluate for leaks and water issues, which can be very costly. We've already been focusing on training and building out our bench strength of DLP team members who can conduct the on-site due diligence in depth. We've been building out our process of how we structure our contracts to make sure if there is a drop, an increase in delinquency or a reduction in collections or an increase in vacancy, that we're getting the appropriate reductions to the pricing we're paying, having exits to the contract. So yeah, there was a lot we're doing in terms of additional due diligence, and as well as to having more control now than we've had in the past. It's definitely been a strong seller's market. So sellers have generally had more control than buyers in terms of the strength of the contracts, and that's we're taking full advantage here on the buying side of that shift, and that we're able to dictate terms that we wouldn't have been able to dictate a few weeks ago.
Okay, we have one here from Bob, and we have a few more here, but this one's here with Bob. It says, we've seen an explosion of construction in our area, southeast PA mainly, higher end apartments and townhouses. What is your expectation regarding the housing market, given the depth of recession and duration are unknowable? Do you see opportunities in this and other parts of the country with a similar situation?
Yeah, I mean, I still believe strongly that the fact that there is a shortage of housing here in America, and going into a recession environment, keep this in mind, it's an important point. Going into a recession environment, all the projects, or majority of the projects, I should say, that are in different stages of entitlement, different stages of development, even projects that are in different stages of construction, we're going to see a lot of those projects stall, stop, get canceled altogether, which is only going to increase the lack of housing here in America. We had talked about at our investor dinners, for those of you who were there in the last couple of dinners before this happened, we were talking about how December was finally first month in like 17 years where there was enough construction to keep up with demand after a decade of the growing undersupply of housing continuing. And that's going to change here very, very quickly. So the fact that there's such a lack of housing is going to create a major buoy in most markets. In addition, in markets such as you just mentioned, the luxury or higher end product, the $2,000 a month type apartments, are the segments that are going to get affected the hardest. The people, and I think that there's sometimes is kind of not realized, is that, believe it or not, the higher end luxury new apartments are the segment that's most often has the highest concentration of hospitality workers, waiters and bartenders and so forth, restaurant managers, et cetera. So there's going to be not only a lack of supply in general and demand exceeds, but more people who were stretching themselves to live in a $2,000 a month apartment are now going to be in search of a $1,000 a month apartment. And it's only going to increase the demand. So again, there'll be short-term challenges. I mean, partially the short-term challenges are being government created. The fact that you can't remove residents, you can't pay the rent, but the demand to take those apartments once you do move out of residence, you can't pay the rent, is going to be very high. And the same thing goes, though, in many ways to the housing market in terms of for sale. Again, the demand continues to exceed supply for good, nice housing and affordable housing in most markets. And I really think that the incredible low interest rates are going to continue to help in driving that activity and keeping the demand high. I don't know if it'll stay at the same levels we've been seeing here of recent, but I expect it to remain in a market where demand exceeds supply in most areas around the country, which is going to buoy any huge declines in home prices.
All right, we have one here from John. It says, as you are looking for new, go ahead, Don.
I'm sorry, I have one thing. So Anthony shot me a note here. So Houston is a market, that right now has 16,000 apartments under construction right now. So there's going to be a lot of those situations, because those are of course not cash flowing assets today, where developers, builders are going to need to unload these types of communities at discounted prices, and opportunity for us to come in and buy, Class A assets at, Class B type prices. And, late 2018, we saw interest rates go up. That might seem like forever ago, but that was, 15, 16 months ago. And we saw that effect of a major increase in interest rates all of a sudden create this opportunity to buy brand new product at a discount, because of the brand new product not being able to refinance out of construction loans and being in a distressed situation. So this type of environment is obviously much more difficult than we were in November 2018 when interest rates rise. And we're going to see a lot of these non-cash flowing projects really struggle, and going to create a new opportunity to pick up these assets at discounted prices if you have the cash to be able to come in and capitalize on them. So there will be a lot of opportunities. That's just one example.
Awesome, thank you. And then this one is from John. It says, as you are looking for new acquisition opportunities and business growth opportunities, are you exploring any new markets?
Yeah, it's a good question. So in terms of lending, we're right now lending in 36 or 37 states now. We have 4 or 5 states that we're all set up legally to lend in, and we just haven't had the right opportunity to do so yet. So in short, no, we're not expecting to go into any new markets in terms of lending. We're already in, the vast majority of the markets that we expect to be in, and actually in many cases expect to increase our volume of lending in the Southeast and in the Pennsylvania, New Jersey areas, the areas that we have the largest density and relationship and infrastructure and so forth today. And then on the acquisition side, we're in, I think, either 17 or 18 states now today that we own apartment communities in. So could we go into a new state? Sure. Example, Tennessee is a state that we've gotten very close to buying in many times. Texas is another one. We actually don't own any assets today in Texas. So there's some great markets in Texas that we'd love to get into, but pricing had been too high. So I think states such as Tennessee and Texas would be the 2 great examples of states that could see us investing in. But the markets we want to focus on the most are the Southeast, Florida, Georgia, Carolinas. Those are markets we believe very strongly in. We have great infrastructure there, and we think there's going to be an increased opportunity to get into those markets at the valuations, at the return profiles we want to achieve. So although yes, we may have some minor expansion, we expect to be doubling down on the markets we're already heavily focused on.
Awesome. We have 2 more here that have come in, and just for the sake of time, we're trying to keep this about an hour. You can see on the screen, you can follow up with any additional follow-up questions. We have the investor success managers on here, Don, Richard, and you can reach out directly. This one comes here from Bob. It says, how do you see the current situation impact the Good as New note fund?
It won't. That's true. So that's a good question. But so our fixed note holders, any of our fixed note holders, anybody who here is getting a fixed note investment with us, you will see no effect on your returns at all. So that's probably the easiest question I've had here yet today, but you have no effect. And I want to reiterate that. We are not in any way, shape, or form here to start prepping you that we're going to lose money, that we're not going to be able to pay our returns out to our investors. We have no more concerns of that today than we did before all this happened. We're going to mitigate risk. We're going to continue to generate our preferred returns out to our investors, continue to pay our fixed returns to our note holders. And overall, if you look at us over the next 3 to 5 years, as an example, I expect our returns to be higher than they would have been, had this not happened, or excluding this event, because we're going to be able to invest at a lower basis. There's going to be less competition. So we're very, very confident in where we sit today.
All right, and then we have this final question here. It's kind of a two-parter. It says, came into the webinar late, so sorry if this was covered. Do you still feel extremely strong about capital preservation security in the next 12 months?
Yeah, I think that was the essentially what my last comment right there. So yes, absolutely. I mean, if you're looking for a place to allocate money where you can be confident you are going to have your capital preserved, you're not going to be subject to losses, you're not going to be subject to volatility, you're not going to be subject to any loss of principal. In addition, where you can be very, very confident you'll have monthly income if you're looking for it, or monthly growth, depending on what you're looking for, and have very consistent, strong returns as we've generated over the last many years. That is not going to change here at DLP. We're very, very confident in that.
And then real quick, this is the second
something
part.
I skipped here before I handed the last question. I want to make sure to remind, especially those who are new here with this, I am by far, I don't know exactly how many times more, 4 times, 5 times larger of an investor here in our property that we own with our investors and our funds that we have here with our investors than any other investor we have in DLP. I have, in our real estate portfolio, over 40% of the ownership, as a simple example. I am not rushing to sell our properties. I am not looking to diversify capital away from any of our investments we have here. I am extremely confident in where we stand. And not only do I have the largest investor, a lot of our closest family and a lot of the leaders here at DLP have a big percentage of their wealth here in our funds as well. And not one of them has asked me or considered or been interested in taking a dollar out, not a dollar out because they think they can go invest in the stock market and make great returns, which I want to urge you. I know that it can seem tempting. I saw some of these banks and some of these builders, some of these REITs that drop 40, 50, 60%. It's tempting to say, hey, let's go play that game. But you have such little control over what's going to dictate the value of those stocks. It is such a great chance that you'll see significant additional decline. Doesn't mean over a long period of time that some of these companies may do great and some of them are fundamentally strong, but we're staying very focused on continuing to double down on what we already do here and continue to focus on doing it even better as we face more opportunities. So sorry, Kyle, I know you were going to ask the second part of that question.
All right, Don, I don't know, your volume may have cut out here, but we can end here with Larry. Larry brought up a point here, said to that point, remember. Oh, there we go. Now I can hear you.
Just not sure what happened there.
Last thing here, Larry. Larry just said, to that point, remember the 20-mile march is about our long-term vision and disciplined action day after day. We're all fully committed as a team. I thought that was a good sentiment here to end our first weekly webinar with Don.
And then please, reach out to any of those gentlemen on the screen, as well as feel free to any of our emails that we sent you in relation to this webinar. Otherwise, to shoot us an email if we didn't get to any topics you wanted to get to. We'll be doing this each week, and we're going to mix up and update the content. Today, we're going to give kind of a broad overview to our overall stance, and then as things evolve and devolve and things change over the weeks to come, we're going to make sure we're out in front of you, both in terms of this format as well as through outbound email communication, letting you know what we're doing, what we're investing in, how it's affecting us, what's happening in the market, how we're going to adjust and capitalize on it, and so forth. So we will be here to give you the confidence and support and direction you're looking for. And last thing I want to hit on, Kyle, for those of you still with us here, if you guys most of you here in this meeting, have had a high level of success in your lives. That's why you're able to invest here with us. You've been successful, and you've probably faced a whole lot of adversity in your life, probably faced a whole lot of chaos, a whole lot of change. And one of the many reasons you're all so successful is because of your ability to react and adjust and face adversity head on and capitalize on it, thrive in difficult situations. And that's what the best do. The best come out of recession environments stronger and better and wealthier than they did before them. And we have 100% confidence that DLP will be one of those doing so again here in this cycle. And I believe the reason many of you have gotten to the level of success you're at is because you have that same mindset and are prepared, to do the same. And you're in good company here. We're excited to work with you. Appreciate the opportunity to serve you, to take care of your capital, generate great returns, and be your capital partner here as we charter some new territory and some new opportunities in front of us. So thank you, everybody.